Guys, welcome to the channel. So today we are going to discuss about oil, inflation and economy, from petrol prices to global finance, everything explained in one single video. So let's begin. um Before that, let me ask you one question. So why do you think that petrol and diesel prices suddenly increase, and why does inflation rise, and how are global events like wars connected to your daily expenses? All these questions have the solutions which we are going to discuss today in our video. So today we'll be connecting everything from fuel prices to inflation, geopolitics and economic policy in one powerful story. So let's start from oil to inflation, the hidden economic chain. Okay. So first let us start with the fuel. Okay, so fuel uh, is the part one of our video. So uh, let's begin with something we all use, that is the fuel. So it has petrol, diesel and crude oil. Petrol, as you know, which powers vehicle and daily transportation worldwide. Diesel drives industry, freight and heavy machinery, and crude oil is the raw resource behind all the refined fuels. So how the rising of oil prices affect the economy? So these are not just fuels, right? So they are called as the backbone of economy. So when the global oil prices increase, the transportation cost, okay, the transportation cost which is there, it also will be increased. The production cost will also be increased, and the goods price the will be increasing, which in uh, result will be leading to inflation. So fuel prices affect almost everything you buy. Okay, next let us see about the special additional excise duty. So in India, fuel prices are also affected by taxes like special additional excise duty. So this is a tax imposed by government on petroleum products. So this helps generate revenue and manage fiscal balance. Next, we have part 2 of the video, which is fiscal side, that is the government role. So fiscal policy refers to the government decision on spending and taxation. Okay, so when fuel price rises, government may use fiscal offsets. Fiscal offsets in case to reduce taxes and provide subsidies. Why does government reduce tax or provide subsidy? Is to control the inflation, right? So the businesses may be conducted nicely, okay, and also the consumers can buy something. Next, we have, this is how the government tries to balance the growth and inflation. Okay, next let us go to the part 3 of the video, that is the global factors. So geopolitics, or so the global political events, which are also called as geopolitics, play a huge role. Say suppose a Gulf War. So when war happens in oil producing regions, okay, the oil supply is disrupted and prices shoot up globally. And this creates what all economists call external volatility. That is, external volatility means instability coming from outside the country. Example, wars, global crisis, trade restrictions, and etc. These are all called as the external volatility. So these impact currencies, commodities, and consumer confidence worldwide. Next, we have the tariff uncertainty, that is tariff related uncertainties. Like when countries increase the tariffs, uh, imports become expensive and trade slows down and prices fluctuate. So the trade barriers create unpredictable price swings across the global markets, When tariffs are imposed, import countries rise in instantly, forcing business to adjust prices, and this uncertainty disrupts supply chains and makes long-term planning difficult for consumers and companies. Next, let us see the historical lessons. This is the part 4 of the video. The historical lessons of 2008 and 2020 crisis. Okay, so in the global financial crisis 2008 and COVID-19 pandemic 2020, the markets crashed, the portfolios lost value, and liquidity dried up. Investors realized the importance of diversification. So, two defending moments shook global economics to 2008 financial crisis triggered by housing market collapse and 2020 pandemic crash caused by COVID-19. Both led to market crashes and fueled the inflation worldwide. So, investment effects during crisis. What happens? The portfolio impact. Let us see. A portfolio includes stocks, bonds, commodities. During crisis, risky assets fall and safe assets rise. So stocks fall because stocks are risk. So market volatility causes the equity values to decline sharply and the safe assets rise. Safe assets meaning gold, bonds and cash become investor safe havens. Next we have uh, liquidity conditions, which is the part 5 of the video, the monetary side, the central bank. So shifting liquidity conditions. So let us see that. So liquidity is equal to availability of money in the system. So when liquidity changes, lending changes, investment changes, and growth also changes. So money supply changes directly affect lending capacity in economy, and when central banks increase the liquidity, banks have more funds to lend, stimulating economic activity, and conversely, tightening money supply restricts lending, slowing growth but controlling inflation. Next, we have inflation versus growth trade-off. So this is a key challenge. Control inflation, which in as a result gives us the slow growth, and for boosting growth we need to increase the inflation. So policy makers must carefully balance both. If you control inflation, there will be slow growth, and if you boost the growth, there will be increase in inflation. So the balance will is a very key challenge. So policy makers must carefully balance the both. Okay, next we have CPI and core inflation. CPI series and core inflation, that is inflation is measured using the CPI, that is consumer price index. So core inflation excludes food and fuel. So it shows the real underlying inflation trend. Next we have proactive monetary policy. That is um, uh, central banks act proactively by changing interest rates and controlling liquidity to manage the inflation and growth. So this is the central bank tools for inflation and control. So as I told you, central bank will be using the interest rates as primary tool to manage inflation. And when inflation rises, banks increase rates to make borrowing expensive, reducing spending. And lower rates stimulate economic activity by making loans cheaper. And this delicate balance between controlling prices and promoting growth is the core of monetary policy. So now let us go to the part 6 of our video, that is currency and global stability. So keeping rupee stable is what the main thing here as Indians. Or else you can take any currency. Here we are talking about rupee because we are Indians. You take any currency, keeping the currency rate stable. So India tries to keep the rupee stable without tightening too much. Why? Because too strong is exports suffer, and if we keep it too weak, the imports become costly. So we'll be balancing it. So strong rupee means cheaper imports, lower inflation, and increased purchasing power, whereas weak rupee is expensive imports, higher costs, and reduced buying capacity. Next, we have foreign currency assets. That is, these are reserves which are held in US dollars, gold, and other currencies. So they help stabilize the economy. So that is all about the foreign exchange currencies. Like Forex reserves are the national financial safety net and held in foreign currencies like USD, EUR, and GBP, German pound, and European currency, and US dollars. So these reserves provide crisis protection during economic turbulence, stabilize currency value, and ensure international payment capacity when markets become volatile. Next, we have effective exchange rate. That is, like this measures the value of a currency against multiple currencies, and it reflects the trade competitiveness and the global position. So now let us go into modern element, that is the crypto and Bitcoin. Alongside traditional systems, digital currencies like Bitcoin are emerging. And they are emerging because they are decentralized, they are volatile, and they influenced by global liquidity. So now coming to final connection part, the complete economic flow diagram. Let's connect everything. So the oil price is rise, which implies that fuel becomes expensive. So inflation increases and government uses the fiscal policy, that is the taxes, reduce and subsidies it provides, and then global events create volatility, and then central bank adjustments, monetary policy, and then currency stability becomes crucial, and investors adjust portfolios. So next time petrol prices rise, remember it's not just fuel, it's global economics in action. So economics is not separate topic, it's one interconnected system. And like everything, I think now you understood how global events, policies, and markets impact your daily life. So, if you had gained some insights and some knowledge and some info that you have never knew and learned now, then please do consider like, shares, and subscribe for more powerful explanations. And see you in next video. Thank you and bye bye and happy livings.